This is Macro Horizons, episode 318, Resetting the Clock, presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Ben Jeffery to bring you our thoughts from the trading desk for the upcoming week of April 7th. And as Trump's trade agenda appears to be set on returning the U.S. economy to the 1980s, we just hope that equity prices aren't also hoping to revisit the same decade. Each week, we offer an updated view on the U.S. rates market and a bad joke or two. But more importantly, the show is centered on responding directly to questions submitted by listeners and clients. We also end each show with our musings on the week ahead. Please feel free to reach out on Bloomberg or email me at ian.lyngen@bmo.com with questions for future episodes. We value your input and hope to keep the show as interactive as possible. So that being said, let's get started. In the week just past, the most defining event was the April 2nd Liberation Day announcements by Trump. New tariffs across the board, a minimum of 10%, with some nations seeing an even more significant increase in levies. Overall, the market's response to this was to focus on the downside risk for the global economy. We saw equities sell off further, and as equities sold off, the Treasury market rallied significantly. 10-year yields got well below 4%, and the 2-year benchmark dipped to 3.50. The yield curve steepened sharply as the market began pricing in greater rate cuts in 2025. We saw the Fed funds futures market pricing in more than 115 basis points worth of rate cuts at one point, and we'll note that assumption seems to be based on the notion that the Fed will continue to view any trade war-inspired inflation as transitory and therefore be willing to resume the journey towards normal policy rates sooner than might otherwise have been the case. We remain somewhat wary of that logic and anticipate that the Fed's response to the heightened degree of uncertainty will simply be to delay rate cuts until there's greater clarity as to how this will all flow through to the realized economic data. The market also saw a stronger than expected non-farm payrolls print for March, where the headline gain in payrolls was 228,000 jobs versus a consensus of 140,000. Within the report, we saw the unemployment rate tick slightly higher to 4.2%, although there was really nothing in the survey that would challenge the idea that the labor market remains resilient. We did see a disappointing ISM services print, as well as a disappointing ISM manufacturing and JOLTS figures. While the disappointing sentiment data didn't necessarily translate into weaker payrolls, it has served as a reinforcement of the divergence between the hard data and the soft data that we've seen so far this year. On the wage front, we saw average hourly earnings increase 0.3% in the month of March, which was consistent with expectations, while February was revised slightly lower to up 0.2%. As a result, the year-over-year pace of nominal wage gains eased somewhat to 3.8%, still above the pre-pandemic norms, but making steady progress back to the 2018-2019 levels. In terms of the market's response to all of these developments, it was notable that break-evens dropped sharply. 10-year break-evens that were trending close to 240 dropped below 218, despite the obvious reflationary concerns associated with the trade war. We're attributing this to the fact that while near-term inflation might be biased higher because of tariffs, in the medium and longer term, the trade war increases the probability of a more significant economic downturn.
Well, it was a bit of a week in the Treasury market. While in a traditional environment, it probably would have been Friday's payrolls report that was the highlight from a macro perspective. That was not what played out this week, and instead it was President Trump's event at the White House on Wednesday and the long-awaited Liberation Day with the announcement of severe tariffs to effectively all of the U.S.'s trading partners that drove the price action across markets this week. as simmering trade tensions have escalated to tit-for-tat tariffs, which has now reached the point of what we'll argue is a full-blown trade war with China implementing 34% reciprocal tariffs on the US, and recession concerns very top of mind, with market pricing now back to 125 basis points of cuts this year, 2-year yields at 3.5%, and 10-year yields closing in quickly on 375.
If nothing else, it was an interesting departure point for the spring. We are looking at this from the lens of an increased round of uncertainty. To a large extent, we were on board with the notion that Trump's Liberation Day would answer a lot of questions regarding the global trade tensions, but in fact, it has simply escalated the uncertainty, and in part, that's what's underlying the sell-off in risk assets and the bid for treasuries. With that context, we're not anticipating any near-term resolution to this degree of uncertainty, and instead expect that the market will simply revert to trading headlines coming out of the White House as well as social media posts. Now, this type of volatility certainly isn't ideal for investors, but it's also not ideal for business leaders. And we make that observation because we have yet to see any material hit to hiring in the U.S. It was a strong payrolls report with only a modest increase in the unemployment rate to 4.2%, so still very low in outright terms. And there's no evidence that the tone shift in Washington due to DOGE has spilled over into the private sector in any meaningful way. Now, this isn't to imply that it won't, and in fact, over the coming months, we're expecting some follow-through in tone shift that will impact headline payrolls growth. But clearly, it isn't evident yet.
And regardless of one's opinion on the tariffs themselves, there's one thing that has become abundantly clear, and to your point on what it means for business leaders, Ian, it's that the inherent volatility around the communication style of these tariffs and such a dramatic reworking of the global trade order in just a matter of a few weeks is making it almost impossible for investors, but also those who run small and large businesses, to make any decision at all, or make any plan in terms of hiring or investment beyond anything that is the immediate short term. To look at the price action in equities, it's clear that the consensus is becoming we're going to start to see this higher level macro uncertainty begin to flow through on the consumer side, and while there's no doubt that payrolls was solid, let's not forget that was data that was collected in the middle of March, and in a testament to how quickly the global macro landscape is changing, the middle of March was a long, long time ago.
It certainly was, although as we look at the real-time measures of the employment market, i.e. jobless claims, there still isn't any evidence of a downturn. The one area of the real economy that does appear to be under pressure is real growth. Now, to a large extent, that is going to be a drag from net exports, which have weighed on projections for Q1 growth, but we have also seen a softer start to the year in terms of real personal spending. One of our primary concerns is that as firms attempt to pass through tariffs to the end user, that consumers are forced to scale back. Certainly, in real terms, for the same amount of nominal spending, one would need to bias real growth lower. The embedded question is, how strong are household balance sheets at the moment, and are consumers willing to lever up to continue funding consumption? When we look at the aggregate expense broken down between mortgage interest and non-mortgage interest, what we see is that non-mortgage interest is now nearly as high as mortgage interest, which is very atypical and reflects the fact that consumer borrowing costs have increased, although most households locked in at very low mortgage rates during the pandemic and to some extent have been cushioned against the tighter monetary policy of the last couple years. So, said differently, the next 6 months are going to be a very important litmus test for the ability of U.S. consumers to continue driving the economy.
And the next logical step in this conversation is, have the recent developments on the tariff front and what has happened in terms of the tightness of financial conditions been severe enough to shift the collective thinking on the FOMC versus what we saw laid out in the summary of economic projections at the March meeting? Obviously, with effectively a 50 basis point rally in the 2-year sector, there's been a rethink of the Fed's ability to remain on hold for an extended period of time, as the risk of a more severe consumer pullback and/or a traditional recession is going to run up against the level of inflation and the trade-off that the Fed is perpetually trying to make between the labor market and growth and the level of consumer prices. At this stage, to look at the dramatic retracement in break-evens and the outright rally in nominal yields, it's clear that the growth and spending side of that equation is outweighing any inflationary angst, but as we get greater clarity on what will ultimately come to pass in terms of tariffs, it's going to be especially telling to see how the communication from the Fed shifts in response to the latest developments.
And to your point, Ben, we've had a lot of conversations that essentially revolve around the question, how will the Fed respond to stagflation? We've made the observation that it's more like stagflation light than the true stagflation seen in the 70s and 80s in the U.S., and that's because we don't have the channel of higher CPI leading directly through to higher wages, which was in place via unions who had cost of living adjustments tied to CPI in their contracts during the 70s and 80s. So if we remove that component and focus on the relatively benign gain in nominal wages seen in March, one can make the argument that while there might be a short-term increase in inflation, at the end of the day, the bigger impact is going to be a slowing of outright demand, hence the Treasury market's rally and the fact that break-evens retrace lower. After all, a significant correction in equities followed by a recession will create forward disinflationary pressures, and perhaps that's precisely what the market is telling us at the moment.
And given the fact that the Fed has already cut 100 basis points, delivered some easing to financial conditions, and brought real rates off the highs, the implicit question is whether that disinflationary impulse is going to be enough to realistically start the conversation around the potential for a cut next month or a cut in June, after what had been a shift in the front-end futures curve to expecting maybe 2 cuts starting in September or potentially no cuts at all this year. Now, earlier this year, when 2-year yields were hovering well above 4%, we saw a reasonable amount of asymmetry in terms of what could go right and wrong in terms of the real economy and what that meant about the risk-reward of being long 2s. But now that we have well over 100 basis points in cuts priced back this year, and the pendulum of sentiment having swung decidedly to the bad side of the spectrum, we can't help but wonder if, at least on a tactical basis, perhaps the move in the very front end of the curve is overdone, at least until we get justification for it from the Fed itself.
And I think that that's the biggest open question. Has the market done everything that it can at this point to push the Fed into pulling forward the resumption of normalization? Of course, if the equity market were to be off another 15-20% by the end of next week, this would be an entirely different conversation. But assuming that there is some stabilization in risk assets, one would also have to assume that the Fed will seek to push back against the notion that it's readying to begin cutting rates again. Given that the tariff changes were just announced, and the fact that the full extent of the reciprocal tariffs from the U.S.'s major trading partners have yet to be disclosed or announced, we're still at the stage in the trade war where the Fed still arguably doesn't have an adequate amount of information from which to base monetary policy changes.
And despite everything that's gone on in the market, really what this cements is what we've been hearing from the Fed, that they're content with the amount of cutting that they've done, and for the time being are happy to stay on the sidelines and allow the data to come in before potentially reacting prematurely to whatever it is that's going to happen in the near term in terms of the U.S. economy. So, if anything, Liberation Day has probably increased the caution or downside risks around the Fed's baseline outlook, but there's simply too much uncertainty about what will ultimately come to pass for the Fed to really have materially shifted its baseline outlook. And so while prices have certainly changed this week, the question of the shift in the facts to justify that moves remains exactly that, a question.
Well, one thing is clear. Liberation Day certainly liberated many investors from capital gains taxes in the equity market.
And I am decidedly liberated for any hopes of retirement, at any time, ever.
As Powell has proved, even transitory can't retire. In the week ahead, the market will remain on edge for any further significant moves in equity valuations. The feedback loop through the flight to quality channel that has led to this significant rally in the Treasury market remains in place, and as headlines related to the trade war continue to be the primary focus of investors, we are anticipating choppy price action in the week ahead, with a bias toward a steeper curve and lower outright yields. We do have Wednesday's release of the FOMC minutes, which should offer some additional insight as to the Fed's thinking about the trade war and the risks that it creates for the economic outlook. We also have CPI on Thursday, and with core CPI seen increasing 0.3%, the market will have, if nothing else, at least an additional fundamental data point from which to base trading direction. However, given how readily investors dismiss the payrolls report, we will argue that the market has become less willing to trade the realized data in anticipation of the potential fallout from the trade war being far more influential over the course of the next several quarters. We'll also see PPI on Friday, as well as get a fresh look at the University of Michigan sentiment survey. We'll note that the University of Michigan report will be for the month of April and presumably incorporate some of the recent volatility in the equity market. While we're certainly cognizant that Powell has downplayed the survey-based measures of inflation, the market will more likely than not take some trading direction from the medium-term inflation expectations component. The Treasury market also has some supply, which will test demand for U.S. Treasuries at these levels. On Tuesday, there will be 58 billion 3 years, followed by 39 billion 10 years on Wednesday, and capped by 22 billion long bonds on Thursday. As a theme, we expect that the auctions will be reasonably well received and don't anticipate any major concession to take down supply. That being said, trade war angst is running high, and there's an argument to be made that some of the auctions might see a pullback in overseas sponsorship that make them more difficult to take down for the street. This is clearly an open question and one that won't necessarily be resolved in the week ahead, but it is undoubtedly on the radar as the Treasury Department continues to fund the federal deficit. We've reached the point of this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. And we have some good news and some bad news. We'll start with the bad news first. Due to the new tariffs and the fact that we import all of our jokes from others, our humor expenses have increased by 25%. The good news is that management has decided to keep the price of the podcast steady at free, and instead our jokes will simply be 25% less funny, which will go unnoticed since we were already approaching zero. Thanks for listening to Macro Horizons. Please visit us at bmocm.com/macrohorizons. As we aspire to keep our strategy effort as interactive as possible, we'd love to hear what you thought of today's episode. So please email me directly with any feedback at ian.lyngen@bmo.com. You can listen to this show and subscribe on Apple Podcasts or your favorite podcast provider. This show and resources are supported by our team here at BMO, including the FIC Macro Strategy Group and BMO's marketing team. This show has been produced and edited by Puddle Creative.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.